Welcome to your lesson of the day. Today, how can you save money on every single trade you make, or at least close enough to it? I think is a very simple and simplistic task, or I think effort that all traders should make, which can improve your P&L on a very, very incremental basis. And where that comes into play is the notion of slippage. So we talk about this all the time. And what slippage is, we have to define it first, is the difference between the price area that you want to get into a stock, so it could be a trigger, let's say you want to buy it when it gets above $10, and then the price that you actually get filled, regardless of how you put your order in. So maybe you put a market order in and you get 05 instead of 01s. Or maybe you hop on the bid passively, instead of getting 1, by the time you get a bid, you get it at 03. So that incremental cost on the way in and on the way out is something all active traders have to deal with. Now, you usually don't think that a penny here or there in terms of shares is going to make a difference. But over time, if you think about it on every single execution, this is going to add up. So first things first, have to make a distinction. There is a big difference between getting into position and getting out of position. Now, when you are going into a long trade, let's just say you want to break out, one of the most simplistic ideas out there, you want to breakout trade, you want to stock above a certain price, you're going to go long once it breaks. So let's use an example, because I always like to have examples of things that happen to me on the day and trade, maybe trades that I missed, right? So 875, opening range resistance on NVIDIA. It broke the 875. I wanted an 875 long. Now, I was willing to get a little bit of slippage, and I crossed up with a limit order. I use limit orders to get into position. Do not use market orders, meaning there's always a price that I'm not willing to pay. So if I, on a break of 75, am willing to pay up to, let's say, 25 cents, I'll put a stop limit order on that break of 875.21 or 22 or 25 or 27. And that way, if I'm long on the break, I get one of those prices and no worse. That's the amount of slippage that I am willing to take. If you don't get filled on the way in, you just end up not getting the position. Now, obviously, if I was short underneath 875 and don't get filled on that break, that means I'm still short, and I want to be more aggressive on an out. Now, I still don't use market orders, but we use very aggressive marketable limit orders to get out. I'm probably going to cross it a couple of dollars. It'll get the best fill regardless, so you want to make sure that you're a little bit more aggressive, or a lot more aggressive in getting out of position to make sure. That said, on that long, you want to try to find that sweet spot between not missing the trade and actually getting the best fill possible. And one of the important things to remember, this is a moving target. Stocks do not stay static. Just because 5 months ago on NVIDIA, you routinely are going to get things like 15, 20, 30 cents of slippage. Back when this stock was $400, $500, when it starts to go parabolic, it opens up a little bit. And the more volatile it is, the more aggressive you need to be with your order. Now, that's obviously to a point. You want to have a good understanding of what the regular spread will be. This is a crazy nonsense, but focus on the best bid and the best ask. And in the middle of the day, it's a 50-cent spread. What the spread can tell you oftentimes when a stock is active at prices like this is how aggressive you need to be. So in this particular case, instead of crossing the routine 20 or 25 cents, you might want to cross that 50 cents. Now, why not $1? Here's why. Because if you end up getting a fill which is too far away from the entry price that you want, it skews your risk to reward. If you're going long at 875 on a breakout, giving it, say, back into this previous level, say that's 74 or 71, if you're willing to risk $4 and you're giving it a wide stop to hold all day long, an extra dollar slippage is $5. And you're getting at a price which is closer to a potential target. So you have less room to the target up and more of a range down. So you have to be very careful considering how far you are willing to cross into that execution. The other thing that you should keep in mind is just getting simple entries throughout the day on what might be dip buys, what might be trend trades, whatever it is. It's not always breakout trades where you get slipped or where you get bad prices. You've got to consider it on other stocks as well. Like, let's imagine I'm trading something like a Boeing here. and it does a wick over VWAP, and I'm looking to short this once it does a fail break at 192.5. But like everything else, you've got to consider, what is the spread going to look like in that situation? This stock has nearly a 10-cent spread. If you have the ability, like we do at Real Trading, to use midpoints or to have multiple gateways, sometimes it makes more sense on the way back down to try to cut into that spread halfway and save yourself maybe 10 cents or 5 cents here, because if you hit that bid, you might not get it all. But if you make the spread, you have the opportunity of saving yourself 10, 15 cents on an entry. Over the course of time, if a winning trade on Boeing is, let's say, $1.50 on a move, you're going to save 10% of that potentially on half of your fills. If you're able to do that on a daily basis, that adds up over time. If in a breakout of NVIDIA, every time I take an NVIDIA breakout trade, if I'm getting 31 instead of 50, or if I'm getting 25 instead of 35, those are going to add up. Like if you're taking a couple of dollars here or there, then saving 5 or 10% per execution, that is huge. If you're making multiple trades a day and then improving by 5 percentage points your profitability, that isn't chump change. So you want to be sure that you're using all the tools to your advantage. Make sure that if you have multiple gateways or multiple stop orders you can use, you're using the one that gets you the best fills and the best liquidity. I can tell you at Real Trading, I'm constantly checking to see what is giving me the best fills and adjusting to it, because I know that over the course of a month, it's going to make a difference. Getting those proper executions, a cent here, a cent there, is going to make all the difference in the world. Now, remember, some traders are going to use limit orders, some are going to use market orders. There is a place for market orders. Do not get me wrong. If you are trading Apple, or you are trading Amazon, or you are trading some of the big cap tech names that with a little bit more stability, market orders are not going to burn you as an active trader. That's just not how it's going to be. So I understand when you pull up a stock like an Apple, which always has a 1 cent spread, sometimes it'll open up for a split second, to 2, and there's always liquidity on there, you're not going to get as much slippage. You're not going to get badly burned by a market order. But if you're trading SMCI, a market order might get the worst possible fill. So you have to understand there is a place for market orders. I just think as an active trader, to get into position, I don't ever need to use one, because there's always a price that I'm not willing to pay. So you got to be very, very careful which one you're choosing. And if you're choosing limit orders, they require more work. I get it. Market orders are going to get you the fill every single time, and you don't have to care about the pricing. But if you can practice using limit orders and get more efficient with your pricing, you're going to save on every single trade. And it does add up. It's a little bit more work and a little bit more consideration as to what price you're going to put in when a key level breaks or in front of a key level. But if you're willing to do it, you can definitely pay some dividends on the back end. Every dollar saved is a dollar earned, and if you're an active trader, then you want to be sure that you're taking advantage of it. You know you're already paying every single time you get in. You pay the spread, you pay a small fee, whatever it might be, but if you can save a little bit, you might as well go ahead and do that. Now be careful being too discretionary with your exits. When you're getting stopped out, you want an aggressive order to make sure you get the fill. But the worst case scenario when you miss a trigger in is that you just don't get into position. Sometimes you can live with that because there's always a price you're not willing to pay to get into a trade. That's your lesson of the day in the Real Deal. You can do it every single day and improve the efficiency of your trading so that you can make a little bit more money.